Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 8th. Welcome to this week's In the Know Trader Show. As we record late Tuesday morning, the market is all over the place today. Currently, S&P futures down about 24 points. The overnight session in futures had a 95-point range, and they opened up close to unchanged, so it's been all over the place. But with oil surging now $9 up to about 129 a barrel, the market's not taking too well to that. But I got to tell you something: S&P only down 23 is not so bad. What else do we have? Let's see, the TNX. So U.S. 10-year yields up 11 basis points today. Significant move there. Natural gas down about 19 cents. Gold is flying up $70, one of the best days it's had in quite some time, and just a hair away from all-time highs. So that is very important. And copper down 2 cents on the day, but about 30 cents or so off of the highs we saw overnight trading. I think it was Sunday night. So lots of big movement going on here across the commodity spectrum as the war lingers on in Ukraine, and things get dicier with oil prices going higher, and the president just very shortly to announce that the U.S. is going to stop importing all Russian oil. So that's not a particularly good thing, and that even reduced supply is going to keep a bid in the oil market. All right, let's take a look at what we have on tap for today. In trader education, we're going to talk about the best way to avoid being a deer caught in headlights, and that is referring to the inability to do anything in the market. So we'll talk about that. In a market overview, we'll take a look at the Dow, the US 10-year, and the gold charts. And then I thought today for the sector focus, we'd look at a variety of different country ETFs to see whether or not you've got some good investing possibilities elsewhere outside of the US. So these are a bunch of popular ETFs traded that are potential ideas to look at to help diversify from the US. To sign up for my weekly ETF Tactical Trader Report, go to intheknowtrader.com on the sign up tab. Same thing for the monthly 7-Eleven report. As a reminder, 7-Eleven outperformed by 82 basis points in February. This is our report that aims to beat the return of the spider over time by being in the best performing sectors and avoiding the worst performing sectors. For our current fiscal year, we're up 2.22%. And since 19 months ago, we are outperforming by 567 basis points, a huge, huge outperformance in just over a year and a half. And these numbers kind of put us in the top 10% of all active money managers in the game. So if you to sign up for these, go to In the Know Trader. We do know there is a problem with the website right now. It is showing up and telling you that the certificate has run out. I think it's as of March 1st. Yes, it has. Do not worry about it. You can still sign up. I am changing websites, and it'll still be In the Know Trader, but we built a whole new website and is shortly to launch. And they're totally different software. So it did not pay to renew the certificate on the old one, but it is fine. You can go there and sign up. Let's take a look what's going on in the sectors. Year to date, the S&P on the far left, the spider is down 11.69%, not including today. Energy, of course, the standout to the upside, outperforming by almost 50%. If you take the minus 11.69 that the S&P is, and energy up to over 37%, you've got a huge, huge disparity there. The only other sector that is just barely up this year is utilities. But the outperformers you can see are the ones closest to that zero line: staples, healthcare, utilities, even Financials losing 8% is an outperformer. Industrials in the bright cyan is an outperformer at minus 7.66. The worst, of course, is consumer discretionary, followed closely by communication services and technology. So you have a bifurcated market, as you often do when it comes to the sectors. And we are very overweight energy in the 7-Eleven report, and that is keeping us in good terms with the S&P because we're also overweight technology, which is not helping. But overall, we keep outperforming, and that's of course the name of the game. All right, let's talk about the best way to avoid that sense of analysis paralysis and the inability to just kind of pull the trigger as we watch the market sell off day after day with very few rallies of significance. If we have an up day, we had that one big up day, I think a week ago or so, but that was it, and the market's faded. And the thing is, what I have found to be helpful when you're very afraid, especially to sell, that if you sell, you're selling the whole, especially given the fact that we're starting to get some downside exhaustion signals from some of the DeMark models, and none of them are confirmed, but you certainly could do some nibbling. So given that, you're kind of afraid to be a seller here, and you just stare at your screen, and every day it ends up in your quote board's in red, and you're just giving back more money or actually losing money, and you really do feel like that expression of a deer caught in headlight that is frozen and just can't do anything. And what I'll tell you from somebody who's playing this game for 40 years, as I have, is that doing anything that reduces some of the anxiety about watching prior gains disappear or seeing losses get bigger is to simply take some action, even if you feel like you're selling the whole. And here's why. And I'll give you something. Yesterday, I actually sold out of some spiders that I had. And I sold them late in the day, which means I sold with the S&P down 100 points. And that's with a daily 13 signal, which is for a buy signal. And I'm going, how could you sell when you have a buy or a downside? Because these gains that I'm taking in spiders that I've had in, let's say my IRA account, I've had them for years, and they're close to doubles. So yes, I'm selling at the bottom of a really crappy day when I even potentially have some buy signals. But it's better to do something than to do nothing at all. And today with the S&P now down 34, I can't say I'm glad. I'm not happy that I sold them down as much as I did yesterday, and as much off the highs as it's been. But I've been trimming some on rallies, but there haven't been many rallies recently, and I ended up just selling what potentially is the whole. But here's the thing: I don't make all or none decisions on my portfolio ever. It took me a while, to build into a portfolio over time. And I don't just sell out on one day and go from 100% invested or whatever percent, but heavily invested in the market to 0%. The likelihood of your success doing that's not very high at all. So I often do things at different times and levels, and depending upon what I see. And again, the market's down almost 40 right now, and it doesn't make me happy per se, but it does give me some sense of satisfaction that I at least did something yesterday that at least, even if it's for a day, is proving to be correct. And in the scheme of longer term investing, it's fine. I don't need to sell the high. I don't need to buy the low. And I'm smart enough to know that what's going on in the geopolitical front is something that is going to most likely be more important than any signals I'm going to get that typically would work if I was, if we were in a rip-roaring bull market and I got the pullback like we've seen, yeah, I'd be all over buying things. But right now, I know that if this war continues and oil goes to 150 or $200 a barrel or more, there's no way the stock market's rallying. So if I sold out even 10% of my SPDR holdings, I at least did something. And of course, I need to sell more. But being a deer caught in headlight doing absolutely nothing is about the worst thing you could do for your psyche. And your psyche is so important to your overall success as a trader. You don't want to come in like every day and stare at your screen and just, kind of wither away as you see stock prices going lower and lower. If you've been a long-term investor, even though the S&P got up to 4,800 and now it's closer to 4,150, a lot of your investments, unless you just came into the market in the last year, a lot of your investments have made money as a long-term investor. And if I'm especially talking about a retirement account, which lets you sell out of things that you own without having to pay capital gains taxes on, doesn't matter short or long term. If it's in your IRA, you can trade your IRA as much as you want. It doesn't matter because it's only when you take the money out of your IRA that you're going to pay taxes on it, and you take it out as it's ordinary income at that time. It doesn't matter what long-term capital gains would have been. That's not part of the equation when it comes to a retirement account. So to me, if I can buy SPDRs back lower than I sell them for now, I'm ahead of the game. And if I can't, and I ultimately pay higher, that's okay too. Because we're in a situation on the geopolitical front that is virtually impossible to predict what's going to happen and when it's going to happen. And unless this Russian-Ukraine situation dramatically changes and Putin changes his tune, we simply have no idea how long this is going to last. And when we get good news about it, and Putin pulls back, and the war at least takes a pause, if not, something more permanent, then yeah, the market's going to come back strongly and quickly. But I don't know if that's going to happen now, or if it's going to be when the S&P is at 4,000 or 3,500 or 3,000. We don't know. What we do know is that we do not have an accommodative Fed. So that piece of the puzzle that has been helping the stock market for so many years, and why buy the dip was the right thing to do, we don't have that piece of the puzzle anymore. So that's already the tailwind that is dramatically reduced. And now you have a global situation, and although it's not our war on our land, it is clearly affecting the global economy. When you have oil doing what it's doing, when you have natural resources, look at what's going on in the metals markets. Look what's happening to the price of nickel, which is a key component to so many things that we use as consumers every day. Look at the price of grains and how much more you're going to pay in the store for everything that's corn, wheat, soybeans related, oats. I mean, your price of oatmeal is going to double. A loaf of bread is going to be probably at least $7 in shortly. And gasoline at the commodity level, the actual raw good itself before states add taxes and all the other things, right now is at $3.80 before you add the transportation cost to get it to the local stations and the the state and local taxes that go on top of it. This war is affecting everyone globally, regardless of if you're actually in the region of the world where the actual conflict is taking place. So I know enough to say, and as smart as I might be and have 40 years of experience in the markets, I also know that I have no control over when and if this conflict is going to end, and that the downside is still potentially substantial. So therefore, even though I'm not selling some stocks anything close to what the annual highs are, all I have to do is ultimately buy them less than what I sell them for, and I'm ahead of the game. And you actually hope to be wrong, right? So let's say spiders that I sold yesterday, I hope I'm wrong on, because I still have a lot more spiders in my portfolio. I have a lot more stocks. But as hard as it was to do to sell late in the day when the S&P was down 100 points, and I'm staring at potential buy signals, I also knew I couldn't just keep going without doing something. So it doesn't really matter to me if I buy the spiders higher or lower that I sold. And I hope I buy them higher, because that means the other spiders that I still have are at higher prices. So I take a small mental accounting loss on this part, but at least I did something. And that's the most important thing, is that you've got to do something rather than just stare at your screen and hope that at some point, at some time, the market will come back. It will, but we've seen from 2000 to 2012, the S&P went sideways for 12 years. We've seen multi-year sell-offs, 07 to 09's bottom, 2000 to 2003. I mean, there are times the market comes off, and this is certainly one of them. So I don't want to, sit there. And as I say, I have lightened up on lots of names, but I was starting to get caught myself into like hoping the market came back. And the more I realized I'm hoping for it, the more I said, do something, Rick, because it may just not right now. So that's today's lesson. And I hope it just it rings true to you in some way, shape, or form, that staring at your screen and hoping something's going to come back is not usually is not usually the solution to the woes that you feel, and doing something is better than doing nothing. So that's today's lesson. Let's take a look at the market. So we'll start off. Here's a chart of the diamonds, the Dow Jones Industrial Average ETF. And you can see that this week, we'd be at the lowest close. You'd have to go all the way back to March of last year. So we're on an annual low as of right now. We broke support that we had been able to hold above. Intra-week, a couple of weeks ago, we got all the way down to the lows of the move, but we closed up, in fact, even above the top of the cloud then. But then last week's high was the top of the cloud. We're beneath the TDST line. We're beneath these lows, and we're on an 8 count with a 6 count bottom, which means even if we get a 9 count, we go sideways and we stay here, and next week we do a 9 count. It's called an imperfect 9, because you always want to see bar 8 or 9 be the lowest low in a downward count. Either bar 8 or 9 has to be lower than bar 6's or bar 7's low in order to have what we call a perfected setup count. We don't have it. And I look at this and I see that the lagging line bounced on the conversion line, which was the bounce in here. And now the lagging line is even lower than the baseline. That opens the door to potentially coming all the way down here. All right, so where's down here? 309. We're at 326. Do I want to do nothing and then hope that when we get the 9 count and 309, that it stops going down there? Well, it may very well, but to me, maybe I buy it down there and sell some here. So that's what effectively I've done. You've got a long rounding top here. It's just there's enough here to say, you need to do some defensive stuff. You cannot just sit and do nothing. Here's TNX on the daily chart. So here's the US 10-year. And we had the 13 and 9 on the top in yield terms. We've pulled back today's big up move. Actually, I'm going to switch this to the weekly because then you'll see that we pulled back to the neckline. There's two necklines actually to draw. I'm going to draw a second one. So the pullback came right to the propulsion momentum level that if we properly broke beneath on a weekly basis would kick in the belief that we would go lower. We went right to it and we've bounced. So, we've come close to the neckline that we broke out from and here. So right now, you're kind of neutral on rates in here. I do think that my two upside targets for this year are 2.16 and 2.5. So this is kind of an important level. The next one would be a little lower here, where the main uptrend line is, and the pullback to the other neckline was. So you've got your zones here, but we knew from the daily chart and the weekly having a 9 count at the same time, the daily had a 13 and 9, that there was a high likelihood, and in a very crowded trade that everybody said yields were going higher, that we get a pullback. The other one is, before we get into some of the country indices, is to take a look at gold. And do I stay here? It's GLD. So look at this huge up move. We've been talking about that we broke out of all downtrend lines that you could draw from all-time highs. We've taken out every prior high of significance. All you have left now, you're actually in a zone. I'll show it to you here. But look at the closing price from that week that made the highest high. Rectangle. So if I build, kind of a rectangle, this zone here is your last resistance in gold. We're virtually against all-time highs. The highest GLD ever traded was 194.44, and we're at 192 and change, right? So we're 1% away from the all-time high in gold. And if you break through this, you get, I think the next target is up. There's nothing on this. I actually have to go to a monthly chart. And the monthly chart showed me that 204.25 or so would be the next upside target here. That's the propulsion exhaustion level from this breakout. And then way up at 251 if you had another massive leg high. But gold bugs have finally have their day, and this certainly breaking out to new highs gives you another 5% move very quickly higher if we do that. Let's take a look at, we're going to have to rip through these quickly. Let's try to get through as many of these as we can. So these are sector, country ETFs. Remember, they're all priced from local, they're all invested in local stocks. So in this case, in Japan, but this is priced in dollars. So the EWJ is actually loses more value because the dollar's been so strong, right? So you have to put those all into perspective. So this is breaking down cloud, lagging line against bottom of cloud within a week or so. If that gives way, then use Fibonacci retracements or something like this where you have a 55 target. You've got very decent overhead resistance here too, and at least one gap to deal with on the way back up. FXI China. Now you want to start, poking your nose into China. Maybe you do, but again, you're buying a falling knife, and I don't buy this. Not in the middle of a new count. So even though we have a sequential 13 here, we're also on a 5 towards another 9 count. You have to really be a very confirmable in order to think that you'll get away with that. Here's a weekly chart of Brazil, 13 on the bottom, 9 on the top against resistance. This is probably a near-term sale, and you'd have to get above 37 to really break that out on the upside. Otherwise, we pull back down here towards 31 or 30 or so. EWT is Taiwan. And this also, we're talking underneath these lows here. This will be the last one we'll get to. But take a look. We're breaking through that. You target these lows, let's say in here next, and breaking through that gets you to the bottom of the cloud. Certainly, distribution for quite some time now. That's it. And hope you enjoyed the show. I'm Rick Bensignor. This has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.